Good morning, good afternoon, and good evening. Whatever time you're listening to this, please welcome to the Market Color Podcast. This is a weekly podcast that is dedicated to providing our listeners with a broad overview of the global financial markets, including a special focus on the Kenyan markets. And in order to deliver on this objective, we have structured this podcast to begin with an overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 157, and in this episode we are reviewing the performance of the global markets during the 17th week of 2025, and that is from Tuesday the 22nd to Friday the 25th of April. And without further ado, this is your host Jamuhuri, and together let's dive right in. We kick it off in the United States, where the US dollar has been weakening and the ripple effect on other currencies has brought a mix of relief and challenge to central banks around the world. Uncertainty about US trade policy has led to a flight out of the US dollar in recent weeks, with the dollar index weakening more than 9% so far this year. According to the Bank of America's Global Fund Manager Survey, 61% of participants anticipate a decline in the dollar's value over the next 12 months. The exodus from U.S. assets may reflect a broader crisis of confidence, with potential spillovers such as higher imported inflation as the dollar continues to weaken. The ongoing sell-off of dollar-denominated assets is now fueling concerns that the ever-changing trade policy from the Trump administration could be doing long-term damage to the financial standing of the United States. The S&P 500 has now dropped by more than 5% since President Trump announced his tariff policy on the 2nd of April. The decline in the stock market has been accompanied by a slide in other major asset classes, including the dollar and U.S. Treasury bonds. There is an ongoing rotation out of U.S. assets, with the dollar weakening and bond yields rising and staying high. During times of uncertainty, the U.S. dollar normally benefits from its status as a safe haven asset, which is a function of the strength of the U.S. economy. However, this time around, with the U.S. being the instigator of the current crisis, the markets have reacted differently. U.S. bond prices are falling, and the yield on the benchmark 10-year Treasury bond has risen above 4.5%, and the U.S. dollar index, which measures the strength of the dollar, has hit its lowest level in 3 years. Moving over to Wall Street, the broad market index, that is S&P 500, rose on Friday, adding to strong gains earlier in the week as investors continue to navigate an ever-evolving global landscape. Stocks have been on a roller coaster ride in recent weeks as traders try to make sense of President Trump's tariff policy, which has added uncertainty and volatility to the stock market. On Thursday, China confirmed that there were no talks with the United States about a potential trade deal, even after the US appeared to soften its stance on trade relations with China. All the three major indices rose for the week, with the S&P 500 gaining by 4.6% to close at 5,525, whilst the Nasdaq Composite climbed by 6.7% to end the week at 17,282, and the Dow Jones Industrial Average was the laggard for the week, but still managed to advance by 2.5% and eventually settled at 40,113. In the Treasury bond market, the yield on the 10-year Treasury bond slipped on Friday as investors weighed the latest developments on global trade policies. President Trump said he would consider it a victory if the United States managed to impose tariffs of between 20 to 50%. He, however, denied that rising bond yields had forced him to grant a 90-day pause on most of the higher tariff rates. These comments appear to dampen sentiment towards the outlook for the U.S. economy, especially after signaling a softer stance on U.S.-China trade relations earlier in the week. The yield on the benchmark 10-year Treasury bond shed nearly 5 basis points to close at 4.25%, whilst the yield on the policy-sensitive 2-year Treasury note was 3 basis points lower at 3.76%. For your information, bond yields and prices move in opposite directions, and 1 basis point is equal to 0.01%. In the commodity markets, the price of crude oil fell for the week, and this was on the back of oversupply concerns and uncertainty around tariff talks between the United States and China. On a weekly basis, prices were broadly lower, mainly due to concerns of oversupply from the Organization of Petroleum Exporting Countries, whilst the outlook for demand remains uncertain given the ongoing trade tensions. On Thursday, President Trump said that trade talks between the U.S. and China were underway. However, China contradicted these comments by confirming that there was no consultation or negotiation taking place between China and the United States. In addition to that, the possibility of a ceasefire between Russia and Ukraine could lead to an easing of sanctions, which would allow Russian crude oil to flow into the global markets. The price of the global benchmark Brent crude fell more than 1% this past week to close at $66.87 a barrel, whilst the price of the U.S. benchmark, that is West Texas Intermediate crude, declined by more than 2% to settle at $63.02 per barrel. In the precious metals market, the price of gold fell 2% on Friday and was en route for a weekly dip driven by a recovering dollar and signs of easing trade tensions as China exempted some U.S. goods from its tariff policy. Earlier this week, President Trump suggested a de-escalation in the tit-for-tat tariff war, saying that direct talks were already underway, a comment which was later denied by the Chinese government. Gold is traditionally viewed as a hedge against geopolitical and economic uncertainty and has gained more than 25% so far this year, owing to the ongoing trade tensions and strong demand from central banks. The price of spot gold hit another record high of $3,500, but was still down by 1.2% for the week to eventually settle at $3,290 per ounce. In the cryptocurrency market, the price of Bitcoin rose for a third consecutive day on Thursday after President Trump softened his approach on Chinese tariffs and toned down his rhetoric against the Federal Reserve chairman. This recent rally was driven by market players capitalizing on a dip in the price of Bitcoin, which has consistently proved its value as a compelling option for portfolio diversification and as a hedge against economic uncertainty and dollar volatility. On Tuesday, exchange-traded funds tracking the price of Bitcoin saw a spike in inflows as confidence in Bitcoin's potential strengthened amid continued stock market volatility and a weakening dollar. According to data from Social Value, Bitcoin's ETFs logged about $936 million in daily inflows. And according to Coinmetrics, the price of the flagship cryptocurrency rose to as high as $94,600 before correcting slightly to record a 2% gain and came to a close at $93,660 per coin. We now change scene to the Kenyan financial markets. And we start by looking at the domestic foreign exchange market, where during the past week, the Kenya shilling appreciated marginally versus the US dollar. And according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.54 compared to 129.79 that was recorded the previous week. Meanwhile, the sterling pound was priced at 171.90 and the euro was valued at 146.85. And on the regional front, one Kenya shilling was changing hands for 28.29 Ugandan shillings and 20.77 Tanzanian shillings, and to the Rwandese franc, it was posted at 10.88. The Kenya shilling continues to trade within a narrow range versus the US dollar, and barring any unforeseen circumstances, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the shilling still remains negative, and this is evidenced by the country's excessive national debt, which now stands at above 70% of the gross domestic product and consumes about 60% of total tax revenues. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves maintained at the same level as the previous week for a grand total of $9.80 billion, which is equivalent to 4.4 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this fact, Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. Please note that in its weekly bulletin, the Central Bank of Kenya does not provide any explanation for the change in foreign exchange reserves. In the money markets, during the past week, the interbank market was sufficiently liquid to meet demand and was also supported through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and credit in the economy. The average interbank rate, which is the rate that banks lend to each other on an overnight basis, this ticked up slightly from 9.83% the previous week up to 9.95%, which was in line with the reduction in the central bank rate. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio of 3.25%, this stood at 4.7 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 24th of April, and the central bank received bids totaling to 42.8 billion shillings against an advertised amount of 24 billion shillings, representing a subscription rate of about 178%. The central bank, however, ended up accepting 42.7 billion shillings, and the results of the auction were as follows. The 91-day rate dipped by 2.6 basis points to average out at 8.44%, whilst the 182-day rate declined by about 14 basis points to level off at 8.61%, and the 364-day rate slid by 5 basis points to settle at 10.02%. In related news, the Central Bank of Kenya has initiated a comprehensive review of the risk-based credit pricing model, which was implemented in 2019. The current model was originally developed as a market-driven solution to address inefficiencies in Kenya's credit market, including high lending rates and a lack of transparency in credit pricing. According to the central bank, the aim of the review is to have a transparent credit pricing model for commercial banks and to facilitate a more responsive transmission of monetary policy. At the Nairobi Securities Exchange, during the week, the equities market was on an upward trajectory, with the NSE 10 gaining the most by 1.1%, whilst the NSE 25 and the NASI gained by 1% and 0.4% respectively, and the NSE 20 remained relatively unchanged during the week. On a year-to-date basis, we see a mixed performance, with the NSE 20 and the NASI rising by 4.5% and 0.4% respectively, whilst the NSE 10 and the NSE 25 have declined by 2.8% and 1% respectively. Foreign investors who dominate trading at the bourse remained net sellers for the third consecutive week, with a net selling position of $1.9 million, and this takes the year-to-date net selling position to $31.7 million. Meanwhile, the price earning to growth ratio currently stands at 0.6 times, which is an indication that the market is undervalued relative to its future growth expectations. Please note that a price earnings to growth ratio greater than 1 indicates the market is overvalued, whilst a ratio less than 1 indicates the market is undervalued. Up next is our topical issue, and this week we're looking at the IMF's World Economic Outlook dated April 2025. According to the previous IMF outlook, global growth, which was stable but underwhelming in 2024, was projected to remain the same in 2025. However, since then, the global landscape has changed dramatically, and governments around the world have had to reorder their policy priorities. This follows a series of trade tariffs initiated by the United States and the countermeasures effected by its main trading partners. The introduction of tariffs is a major negative shock to the global economy and has been worsened by the unpredictable manner in which these measures have been announced and implemented. The swift escalation of trade tensions and extremely high levels of policy uncertainty are expected to have a significant impact on global economic activity. Given the foregoing, global growth is projected to drop to 2.8% in 2025, down from the previous estimate of 3.3% and way below the historical average of 3.7%. Growth in advanced economies is projected to come in at 1.4% in 2025, with growth in the United States expected to slow down to 1.8%, on account of greater policy uncertainty, trade tensions, and softer domestic demand. Meanwhile, growth in the Eurozone area is projected to slow down to 0.8% in 2025, whilst in the emerging markets and developing economies, growth is expected to slow down to 3.7% in 2025, with significant downgrades for countries most affected by the recent trade measures. The IMF has also slashed its growth projections for China and India to 4% and 6.2% respectively. Despite the ongoing tariff war, which is expected to result in higher inflation, the IMF has a contrarian view which projects that global headline inflation is expected to decline, but at a slightly slower pace of 4.3% in 2025, with notable upward revisions for advanced economies and slight downward revisions for emerging markets and developing economies. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if so, please consider supporting this podcast by becoming an active subscriber with a minimum monthly contribution of just $10. For more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major hosting directories, that is Apple Podcasts, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address, that is jamuhuri@gmail.com, Jamuhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, culture is strategy for breakfast. Think about it. Thank you, and God bless.